What's going on, guys? I'm Rob here.
And this is Nick here. Welcome to Coffee and Crypto. Today we are going to be talking about the truth about futures trading.
That's right, the untold truth about futures trading. So, if you are a new investor, you likely have probably never even heard of futures trading. But as you gain more experience investing and getting into crypto, you'll eventually find out about it because you'll hear about other people using it and making insane gains because most people only talk about the gains and not talk about the losses. Where in futures, I would say I don't know, 90% of people are losing money. You have to be very experienced, very skilled, and very dialed in to actually make money. So, Nick, I know you're an experienced futures trader. What's your overall take on it? Let's hear some of your thoughts.
The truth about futures trading. I mean, we can just talk a little bit about what a futures contract is in the crypto space. It essentially allows you to. It's a contract on. You don't actually own the coin when you're buying these perpetual futures. You're just owning a contract at a certain price. And the thing about it is you can go long or you can go short. By going long, it means you're anticipating the price of the coin going up. By going short, you want the price to go down to profit. So imagine you buy a one contract on Bitcoin at say $35,000 and you're not leveraged. And then Bitcoin goes up to $40,000 and you close that contract, you just made $5,000. If you shorted Bitcoin at $5,000 or at Bitcoin at $35,000 and it went up to 40,000, you would have lost 5,000. But what makes futures trading so risky is the amount of leverage that people can use. The example I just talked about was a 1x leverage, either long or short. So imagine instead of buying one Bitcoin at $35,000, you could take, instead of actually having the $35,000 to buy that contract in full, you only had $3,500, but you wanted to buy an entire Bitcoin worth of futures contracts. You could put $3,500 in an account, leverage yourself 10x to buy one Bitcoin at $35,000 to go long or to go short. If you're going to be going long, so if you are leveraged 10x with your $3,500, you can buy an entire Bitcoin at 35,000. So with your $3,500, if you go long, Bitcoin goes up to $40,000, you still just made $5,000 off of your initial $3,500 investment. So in that trade scenario with the $3,500 leverage 10x, Bitcoin goes from 35 to 40. You close your position there. You just turned your $3,500 into 8,500. Conversely, if you shorted and then Bitcoin went against you, Bitcoin would only have to go up to 38, 10%. It would have to go up to $38,500 if you were short and it went against you. And then at that point, your futures account would liquidate your position and you would have nothing left in your account at 10x leverage. So that's kind of the basics and some examples on what futures trading is. It's very dangerous. I mean, I've tried to be an active futures trader on and off for the last 15 years of my life, and I wasn't actually profitable until the 15th year. So it just goes to show you that even with a ton of experience, you can have massive drawdowns like I just did trading Luna futures this week. I mean, it can be a disaster. You can make a ton of money and then lose it so quick. And what even compounds that risk is when you're like these markets trade 24/7 and they're the most volatile markets in the world and you can leverage them. So there's times where I can't even fall asleep because I have a trade open and I either reduce or close my position before I go to sleep because I'm worried about getting liquidated in before I wake up in the morning. So
It's definitely a high risk trading strategy. And just to summarize, we'll use 10x as the example. If the price moves up, if you're long and the price moves up 10% and you're 10x long, right? Let's say you use $1,000, you're now trading with $10,000 because you're on 10x leverage. Price goes up 10%, you've now made 100% on the money you put in. So if you put in $1,000, you now leave with $2,000 because you've made your $1,000 and you walk away with your initial 1,000. So you basically doubled your money.
So yeah, you're right. Whatever leverage level you're using, you're multiplying your profits and you're also multiplying your risk, because if it goes against you 10%, that's when you lose all your money.
So if the price goes down 10%, you get liquidated, which means the exchange closes out your position, takes away all your money as like some insurance fund risk.
Well, no, like the exchange will actually, if you're 10x leverage, the exchange will actually want to close you out. Like if you're down 9%, and then they take the difference, whatever, like say you had $1,000 in an account, they'll close you when you have like maybe 80, 70 or $80 left in the account and wipe you and throw that additional money into an insurance fund for like when there's times in the market where there's low liquidity, high volatility, and the exchange is just doing that to protect themselves.
Yeah, exchanges make a killing on this because they get the liquidation fees, which everyone gets liquidated at some point, and plus there's a funding rate. So you're basically borrowing money to trade on with this leverage, and you pay a funding fee. So the funding fee varies, and it's at different.
Yeah, that's actually how the perpetual futures on cryptocurrency, they use the funding rate in an attempt to keep the actual futures prices close to the actual asset value. And that funding rate varies. And it actually, that rate, a lot of people may not know this, but it doesn't actually go to the exchange. It goes to the traders on the other side that are against you. So if you're long on a Bitcoin trade or whatever trade it may be, and your funding rate is positive, that means you're paying every 8 hours. They'll take a certain percentage of your account away from you and give it to the people that are short. Conversely, there can be a negative funding rate, whether you're long or short. And if say you're long and the funding rate is negative, whatever rate that is, every 8 hours, it pays that to the shorts. So the exchanges don't actually make money from the funding rate. That's kind of just used to increase or decrease the supply and like the dynamics of the market to keep the futures close to the actual target price of the coin.
Interesting. I always thought the exchange got it, but so that's more of like a technical overview of futures.
Yeah, I just wanted to explain that because I heard you say that, and I know a lot of people out there trading futures don't know that part about it, and a lot of them don't know about the insurance funds either. But if you do it enough, you kind of learn these things because you're like, why did I get liquidated when I was only down 9% and I was 10x? But you figure it out.
From my experience, though, so I've done some futures trading, and it's intense. It's all consuming. You can make money super quick, and you can lose money in an instant because you're going to lose money in the beginning because you're not going to know what you're doing. But from my experience, it's one of those things where you have to be completely dialed in because the way I look at it, it's a PvP, meaning player versus player type of activity. I'm going long, you're going short, or if we're both going long, I'm trying to exit my position before you. So it's just like you don't see the other person, but there's a million other traders that are smart, they're looking at charts, they're well versed, they've been doing this longer than you, they know when to get in, when to get out, they're taking very specific pinpoint type trades. So it's a pure player versus player type activity. And if you don't know what you're doing, or if you're not completely dialed in, you're going to get wrecked because you're essentially competing against other people that are buying and selling at the same time. And it's basically a matter of who can get in and out and make it and win or lose essentially. So you have to be fully dialed in, and it gets really tricky when you try and do more than one trade because then you're managing multiple trades. So if anyone has ever done futures trading, or if you wanted to attempt to do it, I would recommend just starting off trading one coin and not trying to open up multiple positions, because the complexity of which you can go into detail on one trade alone, your entry and exit point, stop losses, take profit, all that stuff. And the charts is all consuming.
I wanted to talk about that a little bit because say you have a trade open in Bitcoin, you open it at 35,000, 10x leverage. They're going to show you what your liquidation price is. Say you bought the example before, $3,500, 10x leverage. You buy one Bitcoin for 35,000. Your liquidation price is going to be 35, like probably $3,300 below 35,000. So what is that? 31.7. I think the math works out that way. And they're going to liquidate you at that price. It gets more complicated, like you were saying, Rob, if you have more than one position open and you share the margin, because you can open up in a trade in another coin, long or short, and those trades are sharing margin with another. So like so it's cross margin. So you don't even have the comfort of knowing exactly what your liquidation price is at all times, because if you're long on two separate coins and they both start dumping, while they're dumping, your liquidation price is actually approaching the current price because they're both sharing the same amount of margin. And a lot of people get wrecked by that because they may think their liquidation price was 31.7 or 32,000 on Bitcoin. But if they had another trade open sharing the same margin as the Bitcoin, your liquidation price may go up to 33,000 or 33.5 because you're sharing 50% of that margin with another trade. And that's how people get wrecked. You can get wrecked trading long or short. That's why I always try to, if I'm talking about new investors, don't even touch leverage trading. I mean, crypto is volatile enough.
I would say to wrap it up, because futures trading is something that you can take a whole course on and study for years and still not be successful. So, there's too much detail to go into. But I would say, to wrap it up and to summarize, is that new investors, even intermediate investors, should not use leverage or futures trading. They should just stick to the basics. But if you want to do futures trading, just know it's intense. You need to be dialed in 100%. It's pure player versus player, so it's you against someone else to win or lose money. You can make money and lose money very quickly, and if you did want to try it, I would recommend only starting with maybe a couple $100, maybe $1,000 max, and then if you were to enter a trade, you're only entering a trade with maybe 25% of whatever the amount of money you put in, and then just kind of learning the ropes, and know that you'll 99% chance you'll lose whatever money you eventually start with, until you learn through experience and trial and error.
Yeah, and my final bit on this is, if you really are super interested in trading futures, don't use more than 10% of your portfolio, because it's so easy, especially in the beginning. You're gonna get wrecked. Uh, like I still trade futures every once in a while because it's fun, because you can make a lot of money really fast, and you can also get wrecked really fast. But I never do more than 10% of my overall portfolio because of how risky it is.
Yeah, I would say it's definitely fun, right? It's definitely it's almost like you're chasing a high, but at the end of the day, it's gambling, because you can make money, but you can also lose everything and get wiped to zero. But I think that's the most important point. If someone did want to try it and have some fun, throw a couple $100 at it, learn the ropes, or whatever you put at it, you want to use a percentage of your portfolio. So if you're going in crypto, whatever that percentage of your portfolio you're investing into crypto, then now take, maybe it's 1%, maybe it's 5%, 10%, I would say max, because imagine you're going to lose all that money into futures trading. So I think that's probably the most important point.
It is just like, stay diversified, and just, yeah, don't use your entire portfolio trading futures. You can try it out and test the waters, but it's dangerous out there trading futures.
What's 1% of $10,000? $100.
$100, yeah.
Yeah. So if you're investing if you're going to invest $10,000 for the year, 1% of your portfolio, you can try some futures trading.
And final point, I promise this is my final point, Rob. Don't ever go more than 10x leverage. That's like, I get scared to even go more than 5x whenever I do trade futures, because crypto is so volatile. You get 10% moves in a day and they can wipe you out. And some of these platforms allow you to go 20x and 50x, and that's just like pure gambling. Like, I would never do 50x. So yeah, we can wrap that up there.
We'll wrap it up there, but I would say most of the viewers, stay away from leverage. That's what I would say.
Yeah, I agree, Rob. All right, we'll see you all later.